A trading strategy is the specific way that you approach the market. It essentially determines what and how you trade, as well as when and on what conditions you make specific trades. Now, trading strategies are typically based on two of the main types of analysis, namely technical analysis and fundamental analysis. Technical analysis looks at only the chart of a specific asset, whether we're talking about crypto or stocks or forex or anything else. So only the chart, what the price is doing, what the volume is doing, and what different indicators are doing. Technical analysis thus doesn't really look at anything apart from that. So whether a project is fundamentally valuable or not, it simply looks at how the price has been performing so far and what that can tell us about what it is likely to do in the future. As always, it's important to keep in mind that there are no certainties in trading. It's impossible to predict with certainty what will happen. It's only possible to analyze the current situation, as well as, of course, the past, and then determine what is likely to happen based on historical performance. Fundamental analysis, on the other hand, looks at essentially everything else but the chart. It looks at how valuable a project could be based on what it's doing, what the technology behind it is like, and how likely it is to succeed in its aims based on, of course, its tech and the team and everything else. As you might assume, technical analysis is primarily used by traders and primarily for shorter time frames, so they're not exclusively for shorter time frames, whereas fundamental analysis is essential for investing, so for investing in assets for the longer time horizons. Regardless, it's important to keep in mind that most traders and investors look at both types and use both in their investment and trading decisions. So, for example, one very popular way of putting it is by saying that fundamental analysis tells you what to buy, whereas technical analysis tells you when to buy it. So even if you're interested in investing in something for the long run, it is still probably a good idea to look at the chart and to at least use some basic technical analysis techniques to see which point would be a good level to buy it at and when it would be advisable to de-risk. Apart from this, there are also other types of analysis, such as, for example, sentiment analysis, which looks at the market sentiment, so the way that investors and or market participants are feeling about a specific asset at a given time. Now, apart from different types of analysis, there are also different types of strategies, mainly active and passive strategies. Active strategies are also often associated with trading, whereas passive strategies can also be referred to as investing. With active strategies, they are mostly divided based on the time horizon of individual trades. So scalp trading refers to opening and closing positions very quickly, which is sometimes done within several minutes. Then day trading refers to opening and closing positions within the same trading day, so not typically leaving positions open overnight. Next up is swing trading, which is a bit more long-term and refers to catching a trend, so a trend which can last sometimes days and sometimes weeks or even months. When it comes to passive strategies, more investment-focused strategies, the simplest one is simply buying and holding, something which is often referred to as hodling in the crypto space. This means simply buying an asset and then just holding it and not caring about the market fluctuations and keeping one's mind on the longer time frame, so years or sometimes even decades. Other than that, a popular strategy is to buy the dip, so buy an asset whenever the price crashes substantially. One especially interesting strategy is dollar cost averaging, or DCA. This refers to buying, for example, some Bitcoin periodically, let's say every time that one gets a paycheck. So that way, rather than having an entry, a specific price point, the price that you get the Bitcoin for will be averaged out over all the times that you buy it. To put it quite simply, let's say you buy Bitcoin on the 1st of every month. That means, first of all, that you're buying a smaller sum each time. And secondly, that your average price will be okay. It probably won't be the bottom of the market, but it also won't be the top, which means that you'll be fairly set for the long run. Whichever strategy you pick, one important thing to consider is your exit strategy, so the point at which you would sell your investment. Now, that doesn't mean, of course, that you have to pre-plan a specific point at which you'd sell your entire investment, but simply that it's a good idea to, well, for example, let's say the asset you invested in goes up by 10x. It could be reasonable to sell at least your principal, which is the initial amount that you invested, because then you're not at risk of losing money on the trade. You can view the remaining amount that you have as essentially a risk-free investment, which is also very likely to make you much more rational and much less likely to make impulsive decisions.